the Exxon, the Chevron, they were trading at valuation very, very low, like 5-6 times earnings. And, we were post-COVID already, so the market had normalized. The price of oil was reasonable. And so it was not justified. These energy, oil and gas, fossil fuels for the, next 5-10 years are going to be, and I say, hopefully, meaning if we accelerate the transition that is much needed.
You're listening to IBKR Podcasts. Find more conversations at IBKRpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Welcome to this new IBKR podcast. This is your host here, Guillaume Roux-Chabert from Interactive Brokers Singapore. I am joined by Stefano Grasso, portfolio manager for the Enhanced Value Fund in Singapore. How have you been since the last time we did our podcast, Stefano?
Hi, Guillaume. Thanks for having me. I'm good, all good, thank you. Since last episode, we actually launched a newsletter. It's called Chart of the Month. It's a short, chart-heavy, text-light, monthly-ish kind of publication where we share the kind of analysis that we look at on our day-to-day research. It had quite some success. So the September issue had about 10 charts, and the tilt to energy, our kind of bigger exposure in the fund. So it's free to register. I encourage everyone to sign up, and I'll ask the team to put it in the pod description. So it's going to be easy.
Thanks. And actually, I have subscribed. So let's now dive into the topic. So the overvalued market dilemma, where to find value in an overpriced market. So first of all, can you tell us how you see the current market valuation? And do you think we are in a bubble right now?
The US market is currently expensive by historical standards. But it is always difficult to predict a short-term and even medium-term market move. For the general investor, the best solution is probably to dollar cost average over time into the market, as the tailwind is always there, and year over year, the market should do well.
Right. So let's be maybe a little bit more specific here. You just mentioned about the US market, and you say overall. So I guess where does a portfolio manager like you look for value in this market?
We are, bottom-up stock pickers. So we tend to look at individual company. However, to source for ideas and find interesting areas, we look also at macro level. And if you look at different, geographies, sector, teams, and styles, you can clearly find a more heterogeneous picture than the synthetic, price earning or whichever metrics you want to use to call the market overvalued. So, for example, within the S&P 500, the top 10 stocks account for about 90% of the performance year to date. And actually, in the last few days, for 100% of the performance, meaning that the remaining 490 stocks have a flat performance. So there are, stocks that are around 10, 20%. And there might be more value there than in some of the high flyers that have been running year to date into 2023. If you look at developed markets, even without going into emerging markets, Europe is definitely cheaper than US. Just to give you an idea, you have, things like Norway, and then, of course, Spain, Italy, Greece, that are trading below 10 times earnings, and whereby the US market is trading above 21 currently times earnings. So you can argue that within these areas you can find reasonably priced stocks. Going into emerging markets, they are typically cheaper than developed markets, and even excluding extremes like China, there is a sense of, historically speaking, these are very, very more attractive from a pure valuation perspective. And then if you look at you cut the market in terms of sectors. You look at industrials, pharma, consumer staple events are much cheaper than the information technology running at 30 times earnings. So in general, I would say there are pockets of value, and the value style has never been cheaper compared to the growth that has been the long story, especially now with interest rates on the rise. The market should mean revert and correct some of these excesses.
Thanks, Stefano. One thing that you mentioned is about China. I have a lot of requests to know a little bit better about what's going on and what's your view on the China equity market. A lot of fund managers seems to be very cautious on China at the moment. So I wonder, isn't that so maybe a good time to apply Warren Buffett quote to be fearful when others are greedy, and to be greedy only when others are fearful? So would that buy on fear could apply on China sectors at the moment?
I think it would. I mean, if I have to answer gun to the head, yes, it is one of those opportunities. The risk here is outside what we usually look at and try to price. So is outside the intrinsic of the companies that we look at. Definitely China has a number of very, very reasonably cheaply priced companies. And the problem is the geopolitical angle can really wipe it. And if we look at what happened to Russian equities, they're basically frozen and held in portfolio at nominal value because of the sanctions and everything that happened after the invasion of Ukraine. So I think in the mind of an investor, there is this risk being considered, and therefore they are applying a discount that, of course, you can understand is very volatile, because you can say, it's 20%, you can say it's 80%, you can say it's uninvestable, as someone said. I mean, from a economy perspective, China we see a bit of a narrative that is overdone in a way, but valuation are clearly, either a once in a lifetime opportunity, or are going to be, Russia V2 with a lot of wounds to lick, so to speak.
I see. So maybe to rebound on that and to expand it to another market, maybe after China and due to China, I see a lot of interest in Japan equities at the moment. And it seems that Warren Buffett also clearly took some very strong macro-wise view by getting large footprint on this market with top-of-the-line tickers. So are you invested, you two, in Japan? And what's your view on Japan equities in general?
We are not in our portfolio. We don't have specific Japanese exposure. Of course, Japan is a big market, and it's relevant for many of our portfolio companies in a way or another. But it's one of those markets like, even the Singapore market, that are kind of developed markets, but valuation historically have been very low and have been very cheap markets. And that has to be with a relatively unfriendly shareholder attitude. Typically, this company have, a lot of cash on their balance sheet. They're not returning cash to shareholder. And, I think we participated in an event with Tokyo Stock Exchange, where they were describing the number of attempts that they are doing, and seem to be working, by the way, to kind of correct that. But I still think that the one issue with Japan is that Japan is really for Japanese. And it's interesting you mention, Warren Buffett example. And it's interesting you mention a macro play, because although Warren Buffett is a stock picker, I agree with you. In this case, is more of a macro play. He had a big advantage. I actually did a LinkedIn post last year about this matter. He managed to take leverage and lock in a very substantial amount of money at close to zero interest rates. Because of the balance sheet of Berkshire Hathaway in the last few years, they have been issuing 10, 15, 20 years bonds at less than or around 1% per annum cost of capital. And of course, if you take that, position, the best edge not to stay exposed to the fluctuation of the currency is to match the liability with an asset. And in this case, the assets are this company that incidentally generate majority of the revenue from outside Japan. So it's the edge of an edge. You basically have company priced in Japanese yen that has a very cheap cost of funding this position for Berkshire Hathaway. Revenue coming from outside, US denominated revenues, and very, at the time of investment, they were even much cheaper. Japan had a good run as the stock market in general, and the Japanese trading houses participated into that rally. So he invested, I think, when the dividend yields on aggregate of these 5 position, I believe here, was like 7%. And just the dividend was covering 7 times what he was paying as cost of financing that very investment. So it was a no-brainer. Since then, the dividend got increased, the stock price increased. So it's a difficult to replicate kind of trade that he managed to pull out in size using the balance sheet. I think he really appreciate the company's management and the stability and the business model. I personally hired a former employee in my previous job as head of trading for Eni in APAC from one of this company, and I had to appreciate how the strong culture of this company permeate in the business environment, and really a benchmark, a point of reference for the Japan business life. So I understand the angle from Buffett, but the financial place was just brilliant, very, very healthy.
Yeah, it's kind of very interesting that you mentioned about that, because I think people they just read the top line, but if you drill down, indeed, there's it's almost like a carry trade with equities that Warren Buffett did. Is my understanding correct?
Correct. He rarely invests outside the US because he trusts the legal system. He understands how it works. But I think it was too good to miss, given all the pieces coming together with the financing staying cheap and this company trading at very reasonable valuation. He has been reading these reports of this company for like 50 years. I mean, it's just the amount of knowledge that he has, even though he's outside the US. These are very international company. They have some investments in joint venture together in piece of the business. They're very well-known company outside Japan for the experts. So it was a carry trade that triggered, I think, the investment, but was a very, very sensible and Buffett style kind of setup.
Understood. Well, now that we understood why you did not follow up on this Warren Buffett move, could I ask you about what are you doing at the moment then, and what are your focus, and what do you think we should be cautious about or mindful about?
So I think, from our perspective, in enhanced value fund, we try to build around, four blocks, if you want. Our ideal investment is nothing that we talk about in this podcast so far. So it has nothing to do with, the macro, has nothing to do with if the market is expensive or not. It is looking at, individual company. We're striving to look at, and our preference is to invest all our, portfolio into small to mid-sized company with strong tailwinds, long runways, and conservative balance sheets, meaning low debt and not a lot of risks of leverage in the company. So if you manage to find these, call it gems, and you manage to deploy capital at the right time into this business, basically they should be able to defeat, the macro headwind, the currency devaluation, whatever, things that can happen. It's very difficult, and we have currently invested in 4 of these companies, and we are looking to find or get a reasonable price to the other that we have in our watch list. The second opportunity the second block that we look at are industries or sectors that are inflection points. So here maybe the macro hint is appreciated. So there are like the container sector or the semiconductor sector, or energy, which is the biggest sector for us in the fund. They go through cycle, and if you manage to get into at the right time of the cycle, then you have a few years of enhanced tailwind that is gonna lift valuation. If you think about energy in the sector, energy is trading below 10 times earnings, is the cheapest sector currently in the S&P 500. And, if it's cheap, not because valuation have peaked, but it's cheap because, prices are low, then you are in a good, potentially a good run. The third thing is, looking at opportunities as stocks that have been beaten down. So irrespective again of the macro and of the sector, there are certain situations where there are restructuring and things like that. And if you pick up if you pick up the stocks close to the end of the bleeding, where the valuation is unreasonably low, then again you have a margin of safety, and you can ride to the mean reversion, to a normalization of level, and to some extent to the China market that we discussed before. This is something that it can well happen in the next few quarters, few months, as a normalization really of there is alpha to be generated in that case there. And lastly, we look at the overall portfolio, and we kind of stress test all these positions that we have individual to the macro setup. So if inflation is going to spike, interest rates are going to keep going up or down, how these what we think are great investments, how are they going to do in whatever extreme environment, in whatever stormy environment. And we look at this with in mind the Warren Buffett kind of rule of investing, which is never lose money. And famously said the second rule is never forget the first rule. So we really want to make sure that maybe we miss some opportunities, but if the ties goes out, we have a strong portfolio. So that's how we look at it, and how we can build a portfolio that is resilient.
Thank you. So you mentioned about the energy sector being the cheapest sector in the S&P at the moment. So is that a hint on perhaps one of the few examples you'd like to bring this to life to our audience compared to, I don't know, AI, for instance?
Yeah, I mean, I think energy has many characteristics that it justify for us the reason to be significantly overweight. If you look at, I've got a chat with our compliance team, and we prefer not to mention specific stocks, and I know that also you guys are okay with that. But going a bit into the specifics, we were invested a couple of years ago in the big cap names, the Exxon, the Chevron. They were trading at valuation very, very low, like 5-6 times earnings. And, we were post-COVID already, so the market had normalized. The price of oil was reasonable. And so it was not justified. These energy, oil and gas, fossil fuels for the, next 5-10 years are going to be, and I say, hopefully, meaning if we accelerate the transition that is much needed, is where we have 5-10 years of significant dependence of fossil fuels that we need for prosperity as humanity. So it's a big these big cap were representing that. Then they appreciated quite a bit during 2022, and we rotated into smaller cap names, still in the US, preferably into shale, which has a very strong reaction to oil price. So if the oil price stays supported, the shale small companies should kind of result. There are a number of companies. Many became debt-free over the last few quarters because they paid down debt. So are very very much more resilient than they used to be when the previous crash happened. So it's an element of security that we have. And most recently, we are rotating some of these profits into the transportation sector. So if you look at the oil shipping market, we look at it still as energy related, and there is basically no supply. The order book of oil tankers is at historical low. You have a fleet that is being used beyond their reasonable age. A lot of vessels are close to scrapping age. And the setup, the demand supply is just very compelling on the back of a strong and increasing oil demand growth for the next 5 years, 6 years. So we see the energy as a sector where there are more opportunity than money, literally. Banks don't want to finance anything that is fossil related. Funds are forced by the ESG dictate not to invest there. And we feel has gone a bit too far because we don't have an alternative. So we are actually cornering a market that needs resources to thrive and satisfy what is the demand. So it's not that these companies are doing that just because they're evil. There is demand for this product. The goal should be to take the demand, reduce the demand for these polluting products. So we see there a lot of opportunities that we express in mainly now in small cap North American plays and oil shipping.
Thank you very much. I know also from our previous podcast that things like consumer staples, and you often say like what is boring is interesting actually. So would you also like qualify like the consumer staples are also as part of this kind of like overbeaten sector, and there would be like some gems over there, or you have a different view from what you just described about the energy sector?
I think so. Consumer staples have been doing not very well recently as a sector because it's not sexy, it's not AI, and typically it's trading at a valuation that is justified by the high margins and high return on capital that they have. However, the problem that we see with the sector, if you take a company like Procter & Gamble, for example, is trading at 25 times earnings, which is not a crazy valuation for a company like that. But the stress test scenario in case of interest rates going much higher and putting pressure on valuations downwards, I see a world where next year Procter & Gamble can trade at 15 times earnings. So if that happens, we are a buyer of Procter & Gamble. At this level, we see more compelling risk reward in other part of the market that are more resilient in case of this extreme scenario that I just mentioned happening. So a lot of great company, not overpriced, probably is going to be doing good, but not a scream buy or sell. So we have a mandate from our investors to look for more interesting risk reward than that.
Great. Well, we come to the end of this podcast. I think there are a lot of information about how to navigate the overvalue market dilemma and where to find value in this overpriced market. Do you have any conclusion or anything you would like to add, Stefano, before we close the podcast?
No, I'm very, very happy to engage with your audience. Feel free to reach out. Hopefully, we find some common interest with some of the listeners and readers of the podcast, and my DM is open, and very happy to discuss with like-minded people. So if any of these short conversation triggers some thoughts, feel free to shoot them over, and we'll pick it up offline.
Great. Thank you very much. Indeed, we're going to put your contact details in the description of the podcast, and also for the audience, if you want to reach out to me too, if you want to have another podcast with another title, we'd like to invite again Stefano Grasso as soon as possible. And thank you very much. That was it for me. Thanks, Stefano. Cheers.
Bye. Thank you.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at IBKRpodcasts.com. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education material, such as webinars at IBKRwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at IBKRquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.